Hi, everybody. It's Laura and Jake from Neel Robinson Stafford. And this month we are talking about mortgages and HELOCs. What is a mortgage? You know, we always talk about how mortgages in everyday language, but not everybody knows what is a mortgage.
So to keep it very simple, a mortgage is just an agreement between you and the lender, or I guess the borrower and the lender, and it gives the lender the right to take your property if you fail to repay the money that you borrowed, plus that interest that's accumulating on the loan. And then mortgage loans are used to buy a home or to borrow money against the value of a home that you already own. So most people don't purchase their house just with straight cash. They go to a lending institution and they obtain a loan for, anywhere from 90% of the value of the home, all the way down to 20% of the value of the home. So it's a lot of different ranges, and they bridge the gap to that 100% purchase price with the remaining cash that's needed. And then with a HELOC, also known as a home equity line of credit, that's going to be a line of credit secured by your home that gives you a revolving credit line to use for large expenses, such as, redoing a kitchen, a bathroom, paying off debt potentially, but you're basically using the collateral and the equity that you have in your home to draw on that credit line, almost in a sense like a credit card that's attached to your equity in your home.
And a lot of people do home equity lines of credit because typically the interest rate's a little bit lower. Is that correct?
That's correct, or it can be. So it kind of depends. Obviously, there's a bunch of different factors involved, but that is a big draw to using a home equity line of credit.
So as far as, let's assume somebody is wanting to sell their home and we come to you and we say, okay, we want you to close the transaction out. What is one of the first things that you do to gather information on the mortgages or the home equity lines of credit in the mortgages that a seller might have?
So once we get the contract in and we start gathering that information from the sellers, in this case, the owners of the home, we'll have them sign an authorization form that allows us to actually speak to their mortgage company. A lot of those companies don't allow us to access that private information on behalf of the seller or the owner. So we need that authorization form filled out. And then we also require the account information. So that'll be in our initial, gathering of information from those owners of the seller. And that'll include the account information, so the account number, the property address, the mortgage company, and the contact information, like a phone number for that mortgage company that we can reach out to. And the reason why we need all that is because when we request it, we need what's called a payoff letter. And so that outlines what exactly is still owed on the mortgage or the home equity line of credit in order for us to pay that off and fully release the property from being encumbered by the mortgage or the home equity line of credit, because it is a lien against the title. So we need this official letter that's certified to by these mortgage institutions in order for us to clear those line items when we're clearing title, and for title insurance purposes, as well as for the lenders if lenders are involved for the buyer in the transaction.
So sometimes I know sometimes people may have a zero balance on their HELOC. Maybe they used it, or maybe they took a home equity line of credit out thinking they were going to use it and they never did, or maybe they did use it and they paid it off. Do they always remember to tell you they have a home equity line of credit?
No, they do not. And this is probably one of the largest things that could potentially delay the closing, or has the potential for that. So a lot of people don't consider their home equity line of credits liens or mortgages on title. And it's because they're kind of treated a little bit differently as far as how the users or the borrowers actually use the funds and are required to repay those amounts. So we see it all the time where a seller fails to disclose that they have a home equity line of credit on the property because it is a $0 balance and they haven't pulled from it for 3 or 4 or 5 years maybe. So they just think out of sight, out of mind, no issues, $0 balance. And so when we get the title back, we see that discrepancy there. And so re-requesting that information with how busy everybody's lives can be, that can take a small delay, and then getting the actual payoff letter showing that it's a $0 balance or showing that it has been released or canceled, the lien from the property from that mortgage institution who issued that revolving line of credit, that can take additional time. So, that can take anywhere from 1 business day to as much as 10 business days. So getting all that information up front can prevent a lot of potential delays on the back end. And so we're just trying to be abundantly cautious when we're sending out those information forms to get that information.
Because we don't want any delays in
No.
closing for sure.
Mhm.
So yeah.
And then I do know that a lot of people also fail to realize, and the only reason why we know this is because of all the title work that we do, is that a lot of mortgage institutions fail to actually file releases and cancellations of liens on title for just normal mortgages. So let's say we're handling a transaction, we pay off somebody's mortgage as part of the sale or the transfer of title. We notify the mortgage company that they have to file a cancellation and a release to free the property from being encumbered by that lien.
Right.
Now, I'm going to just pull this random number, but I feel like it's about 10% of the time that we see on title an open security deed. And what that just means is that a cancellation failed to be filed by the mortgage lending institution from somebody way back in the back chain. So if we're doing a closing in 2021, we might see that the person who owned it in 2005 had a mortgage on the property, and their mortgage actually wasn't ever filed and canceled. And there might have been 3 other conveyances to new owners during that 15-year period. And so we have to work with our title insurance underwriters to maybe get affidavits signed or use previous title insurance policies that were issued for owners to insure over those open security deeds that come up on title. So it's not just necessarily those home equity lines of credits that become issues when there is a $0 balance and sellers forget to disclose that. It can also be from previous owners that have open security deeds that the mortgage lending institution just failed to file a cancellation. So if you ever get a client and we reach out to them and we are asking about, open security deeds or potential liens on title, it's not necessarily that it's against them or that they have to pay off a $200,000 extra mortgage that they didn't take out. It's us just doing our due diligence to try to kind of figure out what's happening with title and whether or not it was addressed at previous closings.
And I know you guys do a really thorough job with that and make sure that everything, sometimes there's, like you said, title, I don't know what you call them, title issues, not necessarily title issues, title blemishes that you guys clean up so that when a transaction happens with your law firm, the buyer can be assured that they're getting free and clear title. So I love that.
I would say a very large percentage of all the titles that we clear, so for all of our transactions, there's something on title that was done incorrectly. Because you got to think human error back 50, 60 years, there's stuff that comes up. Now, we don't disclose all that because we're able to actually clear those items, whether they're clerical errors or, like we just talked about, those open security deeds on title from previous owners, or showing proof of satisfaction of liens that had already been paid off. So if we're able to resolve it on our end, kind of behind the scenes, there's no reason to scare anybody by saying there's a bunch of liens on title. That's why we issue title insurance. And that's one of the biggest reasons why you would want your borrowers or your buyers to purchase title insurance when they come to own the property.
So if the moral of the story is, if you have a mortgage or you've had a home equity line of credit, just make sure that you're mentioning that at the time that you're selling your home, even if it's a $0 balance, just to make sure everything is recorded properly and all the cancellations have been recorded properly so that going forward, there's no issues. So.
Exactly. And even if it's a $0 balance, there still might be a cancellation fee that your lending institution is going to require. And a lot of times it's about $25. And that's just for the lending institution to file that cancellation to remove the lien from the property. So there might, even though it's a $0 balance, there still might be that slight additional fee once you get to the closing table.
Awesome. Thank you so much for this valuable information. We really appreciate you.
Happy to help. Great talking with you.
Thank you for watching The Lowdown with the local market experts. You can find us online at lauramilleredwards.com. on Instagram at LME Realty and on Facebook at LME Realty Group.